Okay, this is some example problems from chapter 20. Um, the first one we're going to do is 20-37, a ratio analysis. And in your, you see you're given all this information. You've got um, and yeah, a condensed balance sheet, condensed income statement, and then some information from the cash flows. And so the first one that they want to do is the um, inventory turnover, and so that's going to be the cost of sales divided by the average inventory. So the first thing we need to do is get the average inventory. So for 20 to 21, our beginning inventory is 301,208. Our ending inventory is 367,514. Add those two together. We get 668,722. That's we need to divide that by 2. And we get 334,361. For that, that'll be our average inventory. So we simply take our cost of sales. Now make sure you get the right column. The cost of sales for 2021 is going to be 1,975,471. Cost of sales may also be called cost of goods sold sometimes. And this is 334, 361. Cost of sales is a little more inclusive if you're talking about a service company, right? So it's the cost of people who perform the services as well. Okay, so we simply divide that out. 1,975,471 divided by 334, 361 is going to be 5.9. Okay, and then for 21 to 22, our beginning inventory is going to be last year's ending, 367,514, and then we need the inventory for 2022, which is 332,452. Add those together. We get 699,966. Come on. All right, and divide that by 2, and we end up with 3, 4, 9, 9, 8, 3. Okay, so now we get our cost of sales from 2022. And we look over here and we see the cost of sales is 2,085, 480 divided by the 349,983. And we get 5.955, or basically 6 if we round it up to the full amount there. So, okay, so that's our inventory turnover. Then we need the current ratio. And the current ratio is simply the current assets divided by the current liabilities. So current assets, they total those up for us in 2021. The total current assets is 1,287,488, and we divide that by the current liabilities of 405,401. And we get 3.18. Now, anything below 1 is considered bad. Anything above about 1.7, 1.8 is considered like you may not be deploying your current assets, as well as possible. So, this is a strong number. They're not in any danger of not meeting their current obligations, but it might actually be a little too strong in terms of return on assets and return on equity goes. And then in 2022, our current total current assets is 1,141,800. And our current liabilities is 432,902. And we get 2.63. So it's come 6.4 if we round that correctly. So they've come down into a little bit better, more respectable range there, a little bit closer. Still high. Then the quick ratio. Now, your book does the quick ratio as the current liabilities part stays the same, just like what we did on the current ratio. But then they do what's called quick assets, and they do cash plus accounts receivable. That's one formula. I've seen other formulas. I won't get into it here. Do it this way, but just when you get out in the real world and they have a slightly different formula, that's normal. Everybody does things just a slight bit different. So in this case, we're going to use the same current asset. The same liabilities. So now we're going to use cash and short-term investments. So that's going to be for 21 is 745,044 plus accounts receivable of 40,310. So we get 785,354. We're going to divide that by the same liabilities that we did before. And so that is 405,401. And we get 1.93. Very, very strong. Usually your your quick ratio, or some people call it the acid test ratio, quick ratio. Usually that ranges from about 0.6 to 0.91, somewhere in there. Okay, so our current assets and accounts receivable in 2022 is 630,992, and um, accounts receivable is 46,321. Add those together. $677,313. We're going to use the same current liabilities. I mean, yeah, same current liabilities. And we get 1.56. So again, they've come back down. And yeah, if we were looking at some of this other data on here, their net income has gone up from 151,705 to 232. So it's not like it's lower. This number is lower because they're showing weaker performance. They're showing really good performance. So that's a good thing. And then finally, the cash flow ratio is cash from operations divided by current liabilities. And so in 2021, our cash from operations is 398,137, and divided by our current liabilities. So that's the same current liabilities. 405, 401. So 398, 137 will give us 0.98 on that. And then on our 2022, our cash flow from operation was 499,671. Use the same current liability, 432,902. And we get 1.15. So it's gone up a little bit. All right, so that's problem 20-37. The next one we're going to do is 20-38, and we've got a few different ratios. This one, we're going to calculate the gross margin percent, the return on assets, and the return on equity. Okay, so okay. So our gross margin percent, that's going to come from our income statement. In what years do they want? Do they want all of them? For 18 and 19 in this one. So the gross margin percent is just the gross margin divided by the sales. So the gross margin in 18 was 4054. Yeah, that was our gross margin, and our sales was 5688. And we get 71.3%. And for 2019, our gross margin down here is 4362, and our sales was 5597. And that's going to be 77.9% on that one. Okay. The next one that they ask for is the return on assets. Okay, in order to do return on assets, we need the average assets. So the average assets, total assets for 2018, the average assets for 2018 will be the 5311 total assets at the end of 2017 plus the 4130 at the end of 2018. $9,441, divide that by 2, we get 4720.5. Okay, return on assets. So we need our net income. The net income is 1542 divided by 4720.5 is going to be 32%. 32.7%. That's pretty strong. Pretty strong. Then we got to calculate the average assets for 2019. So we will take our ending total assets, 4130. Right, this year's ending is this year's beginning. And then 5231. Add those together. And divide by 2. And we get 4680.50. All right, now we need the net income. And that's 1294 divided by 4680.5. And we get 27.6%. So we've gone down quite a bit on that one. And then finally, we want the return on equity. Okay, so this is part C, this was B, A, B, C. So we get the same, we need the average equity now. It'll be the same income numbers that we used before, but so now we need the shareholders' equity. And in this case, our shareholders' equity is negative. So we've got 6334 negative plus 7926 negative. Is and then divide that by 2, and we get 7130, and that's also negative. So now we take the same income number we used here, 1542, divide that by a negative 7130, and we get a negative 21.6%. Return on equity. And then for the next year, we've got the 7926 negative, and this year we have 8016. And we get 15,942, divide that by 2, and we end up with 7971. Use the same income number we have here, the 1294, divide that by 7971, that's a negative 7971. And that will be a negative 16.2%. All right, so that's exercise 20-38. We're going to use the same information in 20-38 to do the business valuation. Okay. And on the business valuation, we have 3 ways. We have market capitalization, enterprise value, and the free cash flow multiple. So the market capitalization is simply the share price times the shares outstanding. And we want, what years do we want that for? So 2019, that's the only year. So this is 20-39. So for this one, we need the number of shares outstanding is 300 million, and the share price is 102. So we would get 30,600,000,000. This is in millions, right? So that would be the market capitalization, right? Then number two, it asks for the enterprise value, and the enterprise value is the market capitalization divided by the debt minus the cash. Okay, so on this one, let's see. Back here. So we've got the market capitalization, right? We just did that. The enterprise value would be 330,600 divided by debt minus cash. Total liabilities 13,247. So the debt is going to be, when we look on here, total liabilities 13,247 minus 743. Oh, that's plus debt. 3,600 plus 13,247 minus 743. Let's try that again. Okay, so 3,600. 43,104 million. That's the enterprise value. And finally, they ask us for the free cash flow multiple. Our cash flow from operations is 1,315,000 minus 196, and the dividends were 511. 608 million is our free cash flow. And let's see, we have a cost of capital. And the appropriate cash flow multiplier is 23.4. That's going to be 14 billion 227. Okay, so this is our cash from operations minus our capital expenditures minus our dividend payments gives us 608 free cash flow. The problem tells us that the proper multiplier is 23.4, and that gives us 14 billion 227 million on that. All right, so those are the problems for chapter 20. I hope that was helpful.